Good afternoon, everybody. It is Monday, January 4th, a little after 4 p.m., and we are going to talk about the forecast real quick and then get into the plug-and-play stocks and really review some things that I pulled off of the list before getting into the theory of what I'm putting on the list. We want to really focus on things that are buyable or close to being buyable. There's no point taking a look at things that have straight-up charts and have 100 times price to sales and PE ratios in the hundreds. There's just no point. Plus, we posted a video in the chat room a couple days ago, and it was a pretty good video. And you've heard me talk about leverage and margin and money flows and a multiplier effect when money goes into a particular stock. It's the money at the margin that drives the price up. So in this video that I had posted, he discusses some of the ARK stocks. So some of the ARK innovation stocks and how $1 into the stock was driving $30. $1 into the stock was getting $30 of gains. And it just doesn't make any sense. It's the leverage on the leverage. It's the margin. The question became, what happens if there's a hiccup in the stock market and ARK Innovation has to start selling some things? They are the largest shareholder in many of the stocks that they own. And if there is a market downturn, they have to sell quick. If they sell quick, there's not enough power out there. There's not enough buying power out there to buy these stocks from them until the prices drop a lot. So I'm going to show you a couple of examples of ARK stocks that have gone straight up and then ask you the question, what happens if ARK can't invest anymore as the largest shareholder? They've essentially been doing something that we have always in the industry been very careful not to do, and they've taken the opposite side, which is you don't want to buy a stock so much that it goes up in price because then it's self-defeating. Ultimately, how do you unload it if you're the one that caused it to go up in price? I've experienced this in the options market back when I was one of the earliest big investors in Exact Sciences, and I made people $30 million on that stock. We used options, and suddenly we took a look at the volume, and it was us. It was 70-80% us. So we had to stop. And the only time that we were able to buy calls again was on just a weird semi-regulatory event that drove the stock price down 75%. And we loaded up on leaps, and we were able to get a 10-bagger on the same stock. So twice we had a 10-bagger on Exact Sciences because of the way the market was structured. And this is what's happening with a lot of the ARK innovation stocks. And really it happened with the big technology stocks first. Well, we've seen since September that the big technology stocks, there's just nobody out there to buy them right now. There's not enough money to buy the big technology stocks. But the small and the mid-cap stocks are still getting a bit of a bid, mainly because of a handful of funds. ARK Innovation is one of them, having grown from $2 billion of assets under management to $50 billion of assets under management in just a few years, really the last two. So when you take a look at what ARK is buying, you realize they're the ones driving up the stock price. So who is going to buy some of those stocks when they're 2, 3, 4 times higher than they were a year or two ago? What is their exit strategy there? In the last couple of weeks, ARK Innovations dropped 10%. Why? The market's running out of juice. And as we learned a few weeks ago when I talked about the Federal Reserve, we know that the Federal Reserve is not pumping as much money into the economy anymore. And I show in the forecast today, here we go, not popping out for me. Let's look at it over here. Is you've got the Federal Reserve pumping up the stock market. Remember when Steve Mnuchin said that they were going to pull $400 billion worth of the Fed facility? Leveraged at 5 times, that could be another $2 trillion. So what did I say the Fed was going to do at the end of the year? They were going to pump as much money of that as they could into the markets. And that still wasn't enough to drive the market up very much in December. But you can see that right at the end of the year, Fed money on the balance sheet jumped up. Why? Because Chairman Powell decided, hey, I better use this money while I can. Well, a lot of that money is gone now. So what I think we have to think about is some of those stocks that have risen straight up, what are they going to look like in the not too distant future? So this is one of the Cathie Wood stocks, and I actually have been on this one a couple of years based on advice from a trader friend of mine. Look at this stock run like this. This is Cathie Wood building a position. It's a big position. It's her 7th largest holding. Who is she going to sell to? Well, the answer is it got too expensive, and the answer is nobody. So does this stock keep going up, or does it need to consolidate and come all the way back into this zone here where there's buyers again? If you're the main buyer from here to here, you don't have very many people to sell to. Somebody was trimming right here. So I've taken Invitae and really examined it. And I think it's a stock we want to own. And I think it's going to get down into this range so fast that it's a buy again, but it's going to scare you. But this is a company in the right biotech space. So I invite you to take a look at this and then say, okay, if it comes all the way back down to the 20s somewhere, do I want to own it? I think the answer is probably yes. And you tell me, many of you tell me, but look how far away it is. Shouldn't we raise the buy zone? I get that question a lot. The buy zone's so far away. Is it really? Went from 60 to 42 in a few weeks. Who says it can't go back into the 20s? And in the 20s, near where this gap is, suddenly you start finding buyers, which means you find support. So with Invitae, I'm not raising the buy zone. It's still 28 to 18. There's other stocks, though, that I did raise. Amazon, I basically left the same, but Berkshire Hathaway, I lifted a bit. Why? Why did I lift Berkshire Hathaway? Well, it's a couple things. One, they're sitting on a mountain of cash. Two, they've started to change the nature of their portfolio the last couple of years. You see them getting into technology, Japanese brokerage stocks on the idea that Hong Kong's market won't come back, right? Japan will be a beneficiary of the conflict with China. And with that mountain of cash, Berkshire Hathaway can buy back shares, which they've been doing around $200 a share. So you get this one on a dip. You've got very little risk. It probably beats the heck out of the S&P 500 going forward because of the international exposure and the ability to strike while the iron's hot on any correction, either buying their own shares or buying the shares of companies they want to own. With Delta, I reinstated it from the suspended list a while back, and I'm keeping it on our list for rebound plays, even though I think that most of the airlines are going to have a big problem going forward. They have a ton of legacy debt, and they have a big transition coming where the prices for air travel are going to be pressured upwards because of fuel costs rising, because jet fuel is one of the few things that will rise in price when our oil industry starts to wind down over the next several years and the Middle East gets more control of oil prices in the intermediate term. Delta, though, has their own refinery, which is important, and they are the only airline that I found that has fourth industrial revolution technology. Now, I think I'd be more comfortable buying this stock in the 20s than in the 30s, but we'll have to see where things go. I think it's very important that we realize that if there's a correction, it's because liquidity is flattening out or the Fed is tapering, and that the massive unemployment is impacting the amount of money going into retirement plans. How many times have you remembered the first day of the trading year being negative like it was today? It happens about once every 5 years. Normally, there's inflows from retirement plans. But as we identified 4 or 5 months ago, a lot of people are losing their jobs, and it's not just the low-end people anymore for the wage in the wage scale. It's people with retirement plans, people who were putting $20,000, $30,000 a year away on $100,000 or $150,000 or $200,000 a year income. So the reflexivity, look that term up, right? That's a George Soros word, and you can imagine whatever conspiracy theory you want about him. I think he's one of the patrons of libertarianism and freedom, But on the investment side, he's a brilliant investor. And he understands that at the margin, that's where you get your snap. So if we see a double dip recession, or if the Fed simply stops putting as much money into the market, then valuations will have to normalize. And in the forecast today, I once again showed you valuations. They're off the charts in nominal terms. And in real terms, they're still second or third highest in history. Real terms based on interest rates. So with Ford, I raised the bottom fishing up to 6. Alphabet, I raised the top end of the buy zone a little bit. Itron, we were just looking at on the screen before the meeting. Their compound annual growth rate is only 5%, which is normally too low for me. Here's the thing. They have a big backlog of business, and they're going to grow and grow and grow, and they're going to way overshoot that CAGR. They've set a very low bar. They're going to come in at 7, 8, 9, 10%. And a lot of that revenue is recurring software as a service revenue. So SaaS, where have you seen that before? Salesforce. And it's not going to be on that scale. But one of the things that Shamath talked about in that video that I put up from Real Vision is that he thinks that the biggest transition in the world, the most impact socially and geopolitically and economically, something I've been talking about for 7 or 8 years now, since my MarketWatch days, is that energy is going to remain cheap. Fossil fuels are going to go up a little bit in price, but all the other alternatives are going to come down in price. So the age of expensive energy being a geopolitical and social linchpin is probably over. It's a paradigm shift. And our investments should reflect that. So Itron, who's helping utilities and cities monitor their energy usage as well as their other systems, water and electricity in particular, but they bought Silver Spring Networks, which I invested in 4 or 5 years ago, which is controlling all the streetlights. So I encourage you to take a look at their presentation. And in here somewhere, they show you this. 8,000 customers in 100 countries, 200 million communicating endpoints. They manage 65 million of those endpoints, which means they get a fee. It's a very small fee, but there's 65 million of them. Think McDonald's cheeseburgers over and over and over again, and you can't have a heart attack. Streetlights under management. This is the company that I bought. So they bought the company that I bought. 3 million streetlights under management, and that's going to go through the roof. So we take a look at the companies on here. You have to know each story. And what are we trying to find in each story? That there's something that the market doesn't value. Now, there are certain stories out there that are well-known. Micron, NVIDIA, even Pulte. And on the pullbacks, they're just such strong companies that you want them at the core of your portfolio. Your Amazon, your Google, your Microsoft, your Apple. What I have dubbed the Ma stocks. Partly in honor of my 92-year-old grandmother who just beat COVID and looks like she'll be out of rehab next week, who we've always called Ma. For me, it had a little bit of meaning. Anyway, Microsoft, Alphabet, Apple, and Amazon. They buy a lot of QQQ, pushes these up, even though it's been choppy for a few months now. A consolidation. What do consolidations mean? Consolidations mean that you're starting to separate out the zombies from the good companies. The last time we had this happen was 2015 and 16, where the market basically chopped along sideways for 2 years. And there were a number of factors why that happened, and it might happen again in the next year or so, or two. But these 4 stocks, I'm starting to accumulate in place of QQQ for big enough accounts. So if you have a 6 or 7 figure account, you say, well, I want 25% of my money in QQQ stocks. Maybe you'll do 2, 2, 2, 2, and 17, something along those lines. And honestly, you could probably have half of your money in QQQ stocks, no sweat, maybe even 60%. You just have to decide, what do you want your asset allocation to look like? So I'll have the rest of these up here tonight, and Roku is staying on there. Square is staying on there, and I'm going to write an article about Square. Zendesk I'm undecided about. This one ran up, and I might have to take it off. Pretty much the rest of those are staying on there. I took off EA. I just couldn't get my excitement level up high enough to want EA. It's not a bad company. It's a good company. But is it ever going to be a great stock again? I don't think so. What franchise do they have that's not fully valued? What do they have coming that's going to knock the world over? Maybe it's out there and I just don't see it. Or maybe you have to invest in companies like that and just hope that they hit. That's not really my style. If you're a gamer and you think that EA has the greatest thing coming, let me know. But I think we would have found out over Christmas. I also removed CRISPR. It's just gone up way too much. I mean, this chart here, what would make you say I want to buy this right now? This is another stock that Cathie Wood has bid up. Are you going to be the sucker that buys it from her? I would be surprised if the stock doesn't go back under 100. I'd be really surprised. So maybe this area here, maybe we should be going all the way up to here because of where that is. So I'm not going to even do this on a fib level. I'm going to go where the volume is. But we know that volume goes up. So, okay. So price chases volume. Volume chases price. I do think it'll get down here, though. I think 85 would probably be the most expensive I would buy it at. That's a 618 level there. So from this one level to the 618 level, I think you can make an argument here if they really start chugging out cash. But that's not where they are just yet. For the dividend stocks, most of them are staying. There's only a few that are leaving and a few that are coming in. And the ones that are coming in are REITs. I'm not ready to start adding the utilities right now because my 4 favorite utilities are all expensive. But they were covered in a recent article by Dividend Sleuth. So maybe next quarter we start taking a look at those. But they need to come off quite a bit. Most of these are staying on. Like I said, there's only 2 or 3 that are coming off. And then I'm adding some REITs. So I will actually put together separate articles on the growth stocks and a separate article on the dividend stocks for the different folks. As you've noticed, I've named this dividend collector to be a little bit more descriptive and change this just a little bit so people understand exactly what we're trying to achieve. These are stocks that if you buy them in the buy zones, you generally can own them for years. Now, that doesn't mean you can't trade them if you want to. But remember, if you're going to trade, you need to be very good at technical analysis. Otherwise, you're just looking for a spot to buy something cheap, then hold it through an entire cycle, which is usually at a minimum 6 months, but very often 3 to 8 years. 3 to 6 years is pretty common. Then you have that outside to the long side and outside to the short side, your second standard deviations. And right now we're in a third standard deviation rally that once liquidity changes, as the calls come off and they blow up margin accounts and you lose your marginal buyers, very easy to see a 20 to 30% correction or 40 or 50 even. Some of the stocks are up so much that they really, as I just showed you with CRISPR, they should come down 50% pretty easy. And when people say, oh, that's not real likely, okay, answer me this. How many times in the last 20 years has Apple lost 30 to 50% in a year? Take a look at the chart. Several times. So if the best company in the world, arguably, can lose 30 to 50%, can some of these small cap companies and mid cap companies that are bid up by traders in a couple of funds that aren't yet profitable, it may never be profitable, lose 30 to 50% quickly? I think they can. There's only one other stock I want to talk about today. And that's because I talked a lot about Bitcoin in the last couple of weeks. If you take a look at the forecast, I put a section in here on Bitcoin mainly because it's the thing du jour right now, right? And I think there's only 2 ways to look at Bitcoin. That it's a pump and dump that the government will eventually destroy, or it's a new finite commodity that can be used as a true store of wealth. And there's a lot of people who are saying that's what it is. Here's the problem. They've called it a currency, and that's illegal. Now, I know we're in a day and age where illegal is not that big of a deal, given who was just in the White House, but illegal is illegal. And Janet Yellen has voiced some concerns about Bitcoin. It would take very little in the way of regulation and taxation to crush Bitcoin. That said, What if the governments and the central banks decide not to crush Bitcoin and just let it be a speculative investment? In that case, maybe you want to have 1 or 2% of your bank savings in Bitcoin, which is what I told you. I don't know, what was it? May is when I started talking about that. The other way to do it is buy some of the stocks that are exposed to Bitcoin. Now, you could buy MicroStrategy, in which case you might as well just buy Bitcoin, because MicroStrategy's been losing money in revenue for 6 years, and they just borrowed money to buy Bitcoin. Kind of like all those people who mortgaged their houses in 1999 to buy tech stocks. The stock that I would be looking to buy for exposure to Bitcoin on the idea that it won't get destroyed would be Square. Here's why. Square has a small Bitcoin position that they're not borrowing to make. They're following fiduciary standards, unlike I think MicroStrategy is completely hanging themselves out right now. If they're wrong, they're going to jail. That's really where they're at. Because I don't know how they would argue in front of an arbitrator or a court that they are acting as fiduciaries by mortgaging the company to buy Bitcoin, which is what they did. $650 million or something into something that's only worth $200 billion. So there's $200 billion in Bitcoin out there, and they borrowed $650 million to buy some of it. What if Federal Reserve comes in or Treasury Department comes in and says, hey, financial institutions in the United States and globally through the SWIFT system cannot exchange currencies for Bitcoin. They have to verify that the money that is coming in isn't from Bitcoin transactions. What if they crack down on all this stuff? Not hard to do. You can trace almost everything nowadays. If it appears out of nowhere, you got a clue. What if they put a 20% penalty tax on all cryptocurrency trades? They do it if you take money out of your IRA if you're poor. Maybe they'll do it to traders who are rich. No. We only pick on the poor. I was just kidding. But anyway, Square has some exposure. And if they're told that Bitcoin is not really going to be a big thing in the future, they can still be part of the niche. But if Bitcoin's not part of the future, then digital dollars and euros and yen are. In which case, the financial institutions are going to be the keepers of the blockchains. It won't be some guy in his basement who loaded it up with supercomputers. It's going to be JP Morgan and Square and PayPal and Goldman Sachs and all the other banks around the world in the SWIFT system. And by introducing digital currencies and letting the banks handle the blockchain, what do? You create a quid pro quo. Should have been one of the words of 2019. I hope it was. Save fiat currency, save the banks. I hope somebody knows what this is a reference to. So I expect that it's going to end up like this. But I don't know. So I want a little exposure just in case. I think Square is the way to do that if you don't want to buy your own Bitcoin, because they have a safety net. Even if Bitcoin is crushed, they get to take part in the new currency, digital currency system that the central banks introduce and the IMF. So this is one that we're looking to get into if you're bullish on fintech and you think that digital currency of some sort is a play and you're just not sure which way it is. And I think that's where I'm at. I mean, maybe the pump and dump somehow works for the government. I don't know. Or for the government's patrons, but I don't think so. I do think you're probably going to see Bitcoin at 1/10 the price. I think it's going to lose 90%. But maybe it goes up tenfold first. Who knows? And if they just allow it to be a store of value, maybe it settles down at some point and it just holds its value against inflation, which over a long period of time is important. And that's one of the things that Michael Saylor talked about in one of his interviews, is that he's investing in Bitcoin because it's a store of value against everything else. Well, you know what else is a store of value against everything else? Is real estate. And that's why I'm adding some REITs to our universe, because there's a handful of them that are undervalued, and the capital that it'll take to keep those properties functional and collecting rents on top of the value of the real estate is actually probably pretty well priced into the future. So I'll leave it there for now. And I want you to read this article. It's on both websites. And I'd like to see you think through, or hear you in the chat, read you in the chat, thinking through How do I find companies that are worth taking the single stock risk on? Because you need to not buy stocks that are somewhere around average risk and average return. What is the average risk of the S&P 500? It's 100%. So if you're going to take 100% of the stock market in one company or more, right, take a look at your betas, you better have a lot of upside. So even in our dividend stocks, we want to know that not only can we beat the market just on share price potential, but then the dividend is gravy on top. And then when we apply our option selling, we can crank out another 3, 4, 5, 6, 7, 8 points a year. In which case, if you can average 12 to 15% a year, you're doubling your money every 5 or 6 years. What if the S&P 500 is range bound between 3,000 and 5,000 for a decade, which I don't think is out of the question. I do think that the market gets to 5,000 by 2024, but it might see 2,000 something first, maybe twice. And depending on how things go down with this Georgia election, which I actually think is way more consequential than people think. Read my article. If Mitch McConnell is allowed to block the Democrats' agenda, then we are stuck with high deficit spending without building anything. And as you know, I think we save the world by rebuilding it, not by just pouring money into the hands of the richest folks and saying, could you please share that? Because it hasn't worked for 40 years. The middle class has fallen further and further behind. And in fact, lots of the middle class, half the middle class is just gone and is now lower class as far as incomes go. Some of the classiest people I know, but they don't have much money. All right, I will talk to you soon. Have a good night.